Alright, good morning guys. It is Monday morning, November 21st, 2016, and it's the week of Thanksgiving. So let's go through the market action for this week and see what holds in store for us. First thing we're going to look at are the weekly zones. We're going to take a look at some top and bottom analysis on the markets that we follow. And we're going to take a look to see how the Fed rate hike probabilities actually look on the Fed Watch tool this morning. So let's get right to it. Alright, let's start off with the S&Ps, guys. You can see we're kissing right up against that resistance right there. And I just want you to take a look at this thing. I continue to say for about the past 2 years that down moves are measured in hours and up moves are measured in weeks. That's a ratio that I'm referring to, guys, and it's holding true to form without, it just continues to unfold that way. I want you to take a look when we made the highs back here at 21.95, 3 months of sideways to down action. And we took it all back in about 9 trading days. These up moves, guys, are incredible. They continue to be incredible. It continues to build the case for an explosive rally at some point in time that's going to take everybody by surprise, that's going to go for a very long time, that will eventually mark the end of this bull market unless the new regime gets in there and changes some of the fundamentals in this market. And by the fundamentals, I'm talking about makes progress toward reducing the regulatory environment for corporations, changing things so that all of this money residing overseas can be repatriated back to the U.S. and be redeployed. Completely eliminating Obamacare and putting another more, user-friendly health plan for the masses. So all of these things, and if we top it off, they get in there and dink around with the tax structure and make it better for the individuals. My gosh, guys, this bull market could go for a very long time. So, but until that happens, the market's going to do what the market's going to do, and all you have to do is just see how this thing reacts to the upside versus downside. So the ratio is still intact. Down moves are measured in hours. Up moves are measured in weeks. That ratio just has not changed in about 2 years. So, but anyway, for this morning, here are the levels in the S&P: 2244, 2119. Hey, there is no play this morning. I say again, no play on the weekly strangle. The IV in the S&Ps for this week are 8%. I haven't seen them that low in the S&Ps since I've been trading this stuff. There is no premium at all. I mean, you can't even sell the first levels right here and collect any premium. So that's a pass. We don't play when we don't get paid. So what we need to see happen in order to get a play this week in the S&Ps is a 20 handle down move. We get 20 handles down at any point in time, and you sell these levels right here for everything you've got in your account. This market will not, it won't, for this week especially, it won't go down and stay down 20 handles very long. In fact, if we get 20 handles down and you blink with one eye. Keep the other eye open, because the next time that you blink again, it's going to be back up at the highs. So just keep that in mind. No play in the S&Ps unless it throws us something we recognize. And the only thing I'm going to play is a 20 handle down move, and then I'll be selling that level right there for everything I'm worth. Let's see, enough on the S&Ps. Let's take a look at bonds. I looked at bonds. They expire this week too, and believe it or not, the bonds have got no premium in them as well. I was going to lay that strangle out this morning, but it only pays to lay it out at the first level, and then it doesn't pay enough not to take the trade, because remember, bonds are the most volatile things that we watch, and it violates those first levels there just about 50% of the time. Those aren't the odds I want to. I don't want to take a trade where I know 50% of the time I'm going to have to defend that level right there. So that's a pass on the bond market as well. Again, part of this game is knowing when not to take your regular trade, and we're going to pass on both of those this week. Now let's take a look at crude. Crude's just ripping up. I think we've got that OPEC meeting this week, but just look at that rip off of the lows right there. So she's up this morning. Here are the levels: 52.15 and 42.35. Hey guys, I sold the 42s this morning, 42 puts. This thing just looks like it wants to get higher. If you don't have a position on in crude, this is exactly where I would put a strangle on. I mean, I love putting strangles on in mid-range in this thing when it's ranging itself the way it is. I mean, look at this thing. 40 to 42, 50 to 52, that range right there. We're at 47. We're dead smack in the middle of that range. Guys, this is where you lay into it if you haven't laid into a strangle yet. So it's perfect. I would never put one on, in a move like this going straight down. I would not put a strangle on right there. I did, for those of you watching, I put strangles on in this move only because the IV was so high. When you get the bump up in IV like we had here at the election, yeah, I'll sell a smaller strangle right there. But this is the point that I really like. Ranges, right in the middle. That's where you want to put that strangle on. Or if you have one on you haven't added to, it's a good place to add. IV is pumped up. They've ratcheted up IV since I've been watching it this morning. So it's up around close to 50%, for this expiration cycle. So, they're probably going to pump more IV into the market. For those of us that have crude strangles on, just be prepared for that this week. They're probably going to ratchet it up a little bit higher. So that means no matter what crude does, we're going to be fighting against the premium increase. And then after the meeting's over, I'm sure crude, however how it's going to react, then the premium will come out of this thing. All right, the dollar, we got levels up at 103.97 and 98.29. We had a little reaction down this morning after a huge run up. So this thing has really rocketed higher versus the gold, which is really sold off. So those two are moving opposite each other, just like the old days when relationships actually mattered. Relationships don't matter in the stock market anymore, guys. It's probably like the relationships, the Wall Street traders have with their little side action things. They don't mean anything. But now the relationships do. So hey, one way to play this, oops, sorry about that. One way to look at this, guys, is get back to gold here. Is a pairs trade. Gold versus the dollar. This is what you want to see when you see two markets that are moving, and they're and the correlation to those up moves and down moves. That relationship is where you typically see it. So up in the dollar, down in gold. When they get like this right here, these are excellent places to put pairs trades on. Buying gold, selling dollar. I'm going to take a look at that a little bit later on, see if it's worthwhile putting on. Alright guys, that's it for the weekly zones. Let's move into let's take a look at the Fed watch. Hey, it was about 6 weeks ago we looked at it, and there was a 68% chance of the Fed hike. I think it was last week we pulled it up, and there was an 81% chance. Today there's a 95% chance the Fed is going to raise on 14 December. This thing is continuing to ratchet up. I would not, this is one time I would not bet against a rate hike. So I think we're going to see some volatility on this. I think the Fed's going to go in there and raise and spoil another December. I believe that's going to steal December away from us. That's the only thing that could, that's foreseeable. So, we could have 3 Decembers in a row that are just completely aberrational based on, 30, 50 years of watching, not watching it for 50 years, but I've watched the S&P for close to 30. And, you're able to go back and take a look at how Decembers fall out all the time. It's one of the most bullish time periods in history, where you can just about bank on a volatility collapse. Even though volatility is just pitiful right now, most Decembers you go in, you see that vol collapse. This December, this past December, the December before last, well, we know what's happened the last 2 Decembers. It has bucked the statistics. But, when you're looking at how statistics unfold over 50, 60, 75 years, 2 Decembers in a row, it may seem like everything's broken, but it's not. It's just the statistical distribution of how things work. It means absolutely nothing in a data series other than it just happens. So the December bet, no matter, even if we still get a lousy December this year, that is not going to deter me at all. You can't flip-flop on tried and true methods that have withstood the test of time. So we know we're in an aberrational period. We know that everything's insane. We know that this market has been manipulated to the point where it's got to come unglued, and the things that have worked throughout the existence of the stock market just don't work anymore, just because of the overt, covert, clandestine operations that the federal government, the central bankers, and the Federal Reserve have all instituted. So anyway, to look at the Fed Watch tool, 95% chance of a rate hike. So I think the Fed. Hold on, we got a little Dwight playing in the background here. Yeah, I think she spoke Friday. What I read was she's really tipping her hand toward a possible rate hike. So again, for us, that just means, I think, volatility. So that's good, but we'll just keep an eye on the markets. Watch them close. Be prepared. And be prepared for this market to fool us. Be prepared for it to not do what it's supposed to do, because that's what it's done. It's been the year of 3 standard deviation moves. Now, I said that earlier on this year, and it has held true to form every move it's made. It's made 4 standard deviation moves, which is so statistically improbable of happening that but look at what this thing has done, guys. Historic moves out of the gate. As soon as the bell rang on 1 January, this thing has just made one aberrational, historic, and epic move after the other. Alright, enough of that. So let's, hey, I want to take a look at some charts here. So let me pull a chart up. Alright, let's see here. Okay, we got the chart going. Let's put some, put a study on here. Alright, beautiful. Alright, let's take a look at the S&Ps. Alright guys, what I have loaded on here is I've got just the trend model that you guys are aware of. Here are my little sell signals. Here are the buy signals. You see them right there. There's a couple other things going on in this study set as well, but also I have overlaid here some moving averages of a cycle study. So it's not moving averages per se. It kind of looks at cycles in the market. So this upper line here is a good resistance point. It's adaptive in nature, and below that the market has a chance of selling off more. Above it has a chance of rallying more. That's the only interpretation. So But down here in the lower pane is, you guys know I like to find methods that measure market moves, especially extremes. That's what I really like to measure. So here's one that tells us, when it gets down below this line here, we're in a potential down market, a place where it potentially could rally from. Now I use this study here in conjunction with a lot of my other top and bottom picker studies, but this one works really well on tops as well. So you can see that when it bubbles up above up here, we're getting into some areas where it's topping action, and we really don't stand a chance of getting a top until we pass through that upper band. So same with the down moves. Once you pass up through the lower band, you can I'm not going to say it's safe to play from the long side. There's a couple other things I look for, but in the stock market, it passes through this lower band. It's hasta la vista, baby, because we know this market never comes back down and retests anything to the downside. So you can see here that what was good about it was this down move here never registered. So we had that rally up, slow trickle back down, and then it registered the low right there. So it kissed it right here, kissed the bottom right there. You can see here, registered that top, got underneath it, and that's when the market got a little weak. So I like the way this thing measures tops and bottoms. We're going to use this quite a bit because I'm refining my top and bottom model picker so that we can put that back into play. I'm trying to get that in play for the upcoming bull run that I anticipate. So we can use this on stocks, specifically maybe on some smaller time frames to get into some positions. Alright, so S&P is rolling back up to the upside again. Again, we do not want to bet on a downside move until we get down below. We pass back through this level here, and then we might get some action to the downside. So we'll see if that coincides. We've got a couple of weeks until the Fed comes out. Maybe we get enough action here to flatten this out, get it close, and who knows, maybe we repeat what happened last year. We have a volatile December, one of the most volatile Decembers since 28, and maybe we get the same play this year. I'm going to be ready for that. I'm not going to be tricked like I was last year and have the IV completely. The IV last year in December was the most aberrational thing I've ever seen. Wasn't the fact that it was excessively volatile for December. It was the fact that the premium didn't compensate for it. So that's why I had such a hard time through December. Even though I ended up, closing the month out December 31st with a 10% gain on the portfolio. But then y'all know I took the big directional bet, and the market never ticked one tick higher until about mid-February. So anyway, that's what we're going to look at for December. You can also see here I've got this cycle analysis tool. It's in conjunction with my other model that I trade. You just don't see the other model. I've got it hidden right there except for my signals. But you can see here when the shorter term cycle analysis gets above this one, that's just confirmation that the bull market's underway. Underneath it, confirms that bear market's underway. The dividing line is market above the action, market below this action here. So it's pretty well defined adaptive line. All right, let's take a look at the bond market. All right, bond market really in a down move here. So this thing is registered probably as low as you will see this thing in the bond market. Yeah, it's never been this never been this low before. But you can take a look and see back in here, when this thing does get in this action, it started bleeding off. Your eye is automatically gravitated to this. Oh yeah, that's the bottom. Well, you spent quite a bit of time below it before it actually grabbed traction. So the safe trade, again, guys, is when it gets back above that line. You missed some of that meat. Now, we know that we can also, anywhere below this, and we can play options 3 months out, betting on an upside move. Then you just sit and wait. You define your risk. You make your play, and 3 months down the road, excuse me, guys, it stands a chance of pulling out of it. So right there, we get down below here. You can see it's higher. We get down below, it starts tracing it out. See there, guys? I mean, even though it's in an area, you need to play this thing for about 3 months out. Gives you a chance to set through all this until it gets back going again. Here we go, set through it again. When it finally does get above, it still shakes you out. It's not a guarantee, because the bond market kind of acts differently than the stock market when it comes to down moves. So you've got to wait. And this is the favorite pattern I like right here. Is when it makes the low, it's below it. We make another thrust into all-time lows, and we're making higher lows here. So that's when you can really, if you have positions on back in here, you can add to them right there. We never want to bet the bank, on the first tranches down, guys. You want to tranche into these things. So you can see lows here, makes a final low, higher low, upward. We get just a probe down right here. You could tranche in on this down move, and then it goes higher. So again, you can see it's a little blip up, tips back down, big move up. Just a really good bottom picking tool. There is no tool in existence that is going to pinpoint a low guy within 1 or 2 days. Anybody that purports to have something like that's just a professional liar. They're probably a politician, and they're good at their craft if they can convince you of that. But we'll take a look at the cycle analysis. You can see here action above, and action above this line, and we're bullish. We shake out, move back above, we're higher. So the bond market gets under it, stays under it the whole ride down. Just a really nice, really nice tool for identifying the market levels. Let's take a look at crude. You can see crude here. Each market has its own characteristic. Had a nice bubble down, rally up. Now we're in another bubble down. Now it's crossed back above, guys. That's one of the reasons I sold the 42s this morning. I sold 42 puts on this thing this morning just because it's already rallied like 10%. It's back up in that range. I feel safe on the 42s right now. Things could change after the OPEC meeting, but I got to play what's in front of me. I'm not going to wait for the OPEC meeting to get here. That information is going to leak out beforehand. The guys that are on the inside are going to be trading this thing. They'll more than likely they'll get their positions on. The market will they'll do it very subtly. They'll try to, but it'll probably drive the market one way or the other. And then they may try to shake everybody out prior to the OPEC meeting, and then after the OPEC meeting goes, then it's the wild, wild west, or potentially. Who really knows? I have no idea. But take a look at the cycle model. Above it, bullish. Below it, bearish. So it's good to not bet against this thing. That's all I'm saying. Is it's just another tool in the tool bag where you have a slight, I'll call it a slight edge. I haven't tested it enough to really see that. So I'd have to lay. You'd have to analyze the amount of time it spends below that versus up that, and I think you'd come to the conclusion that once it gets above it, it stays above it for a certain period of time, or a certain percentage move once it moves above it. So that's I really like it for that. I've looked at it quite a bit over the last 2 weeks, and so anyway, that's one of the reasons I sold this morning. Is bottom analysis. We're up. We closed. We're moving above the lower band right there. Now, if we were to come back down and make a lower low, and this cycle, this bottom picker right here would make a higher low, that would be a time where I would really want to take a long position in crude. So just so you can see how this plans out, are some of the scenarios that you can use with this indicator. Take a look at the, I'm not really look at the dollar because we'll just look at gold. Gold is the absolute, well, yeah, I will. I'll take a look because I'll show you why I think the gold and the dollar pairs trade would be so good. Alright, so we're up here. We're right there in gold, or in the dollar. We're way above the upper boundary, indicating that we're in a potential strong up move. Could be in a top, we don't know. You could go back and look at the other times we were above it. We bubbled up really good there. It got a small sell-off, nothing much to bank on. Even when we got below that, it held. I mean, it held strongly and immediately started moving back up. This up move area right here, when it finally did sell off, we got below it, and it acted the way it, in a strong market, acted the way it's supposed to. You know, we got below, and then it was weak until it hit this bubble area on the downside, crossed back through, and then it acted like it's supposed to. So it's just a guide, guys. That's all it is, a guide. Put some context around these moves to help us identify extremes, and that's all we're trying to do. All right, so remember, the dollar is strong and gold is weak. So again, this is where we buy the dollar, buy gold and sell the dollar. That, you know, when the relationship is like this, that's a really good pairs trade. You don't need any other analysis other than that. They're both at extremes. You want to bet that they're going to make a reversion to the mean, and you know that reversion to the mean would be gold closing back up and probably getting really close to the center line. And the dollar doing the same thing, coming back through and getting close to that center line. So that's all we're looking for, is just a trade like that. So guys, I'll tell you what, I think that is going to do it for this morning. What we've done is taken a look at the weekly zones, looked at some top and bottom analysis, told you what I did this morning, sold the 42 puts in crude. We're going to hold on on any S&P trades unless we get a 20 handle down move, and then we're going to take action and sell those 2035 puts. And we took a look and saw that the Fed rate hike's like 95% chance of rate hike 14 December. So that's going to do it for this morning, guys. Have a nice trading day, and have a nice Thanksgiving week. This is BA signing out.